How do you finance co-ops and manufactured homes? Imagine finding a home that fits your budget and helps you build wealth for future generations. Understanding how to finance different property types can make that dream a reality. Let's explore how to finance co-ops and manufactured homes, two options that can open doors to homeownership for many. Starting with co-ops or cooperative housing, you don't own the building itself. Instead, you buy shares in a corporation that owns the property. These shares give you the right to live in a specific unit. To finance this, you need a special loan called a co-op loan or share loan. Lenders look at the financial health of the co-op corporation, including its savings and how many units are occupied. They also consider your personal credit score. Typically, down payments range from 10 to 20% of the share price. Because co-ops charge monthly maintenance fees to cover building expenses, lenders include these fees when calculating your debt-to-income ratio. It's important to understand these fees because they affect your borrowing power and your ability to save and build wealth over time. Now, let's look at manufactured homes. These are factory-built homes that can be moved to a location or placed on a permanent foundation. How you finance a manufactured home depends on whether it's considered personal property or real estate. If the home is not permanently attached to land, it's usually financed as personal property with a chattel loan. These loans tend to have higher interest rates and shorter terms, often 5 to 15 years. If the home is permanently affixed to land you own or plan to buy, you can get a mortgage similar to a traditional home loan. These loans often have lower interest rates and longer terms, like 15 or 30 years. There are several government-backed programs to help buy manufactured homes. Federal Housing Administration loans are popular because they requiring only a 3.5% down payment and have flexible credit standards. These loans are especially helpful for Black homebuyers who may face higher denial rates with conventional loans. Fannie Mae and Freddie Mac also offer mortgage programs for manufactured homes that meet certain standards. These programs sometimes allow for down payments as low as 3% and treat the home as real estate if it's permanently attached. Veterans who qualify can use VA loans to finance manufactured homes and land with up to 100% financing. The United States Department of Agriculture loans are another option, especially in rural areas, offering full financing with no down payment on eligible homes. For Black homebuyers, these programs can make a big difference. They help lower upfront costs and provide more flexible credit options. Building equity in a manufactured home by attaching it permanently to land can turn it into a valuable asset for future generations. Understanding these financing options can help you choose the right property type and set you on a path to long-term wealth. In short, financing co-ops involves loans that consider the corporation's financial health and your monthly fees. Manufactured homes can be financed as personal property or real estate, depending on how they are set up. Government-backed loans like FHA, VA, and USDA programs make it easier to afford these homes, especially for those facing systemic barriers. Knowing your options helps you find a property that fits your goals and builds wealth over time.